everybody, Simon Dixon here, and welcome to a video on the future of crypto yield. So today has been, not even today, this week has been an absolute disaster for our industry, for our sector in both the traditional markets and the Bitcoin and crypto markets. So today I have had some quiet reflection. Not that I've had much time to quietly reflect, but where I can find a second to quietly reflect, I've also been doing meeting after meeting, and we are about 2 to 3 months into due diligence on crypto lending platforms as well. We've been going really, really deep. In fact, we paid approximately $1 million in legal fees just going really deep into some of the due diligence on crypto lending and crypto yield. And I would like to share with you some of my findings, and then we'll head over to Twitter Spaces to take some of your questions. So the first thing I'd like to do is if you subscribe to my YouTube channel, Simon Dixon, hit the subscribe button, hit the bell symbol, hit all. Every time we go live, it will notify you. And if you go through the archives, you'll see lots of video as we've been through this Chapter 11 process. In fact, the archives go all the way back to the very first Bitcoin conference where I spoke way back in 2011. So enjoy the journey if you're a binger. But otherwise, I'm going to be covering today the future of crypto yield because it's such a topical business. In a sense, the Lehman Brothers of crypto moment has arrived and everything has imploded. So we are at that critical moment now where we need to go back, reflect, adjust, and rebuild. And so I'm going to share with you in this presentation what went wrong and how we rebuild. So I've got a little presentation for you. Firstly, if you could just share this with somebody, if you'd like somebody else. We have lots more people that have unfortunately, it's very sad, joined the Chapter 11 club, or they will be joining the Chapter 11 club. I'll share with you what's happened and the different companies. And you know, it's a very sad moment that so many of us are in this experience that we've been experiencing as the 21st largest creditor in Celsius. But fortunately, many of our community were protected. It was only a small part of my net worth, but it was a small part of other people's net worth if they followed some of the risk and money management. But I'm going to go back to basic principles, first principles, as I always do in my videos, and I'm going to jump right into the slide presentation. So let's firstly start with a slide share. So hopefully you can see my presentation. So firstly, all these opinions are my own, but I'm going through some Bank to the Future slides because we're working on solutions for Chapter 11 for creditors at the moment. So let's jump straight in. Okay, so first thing, not legal advice, not investment advice, and not tax advice. I can only give you educational content. I'm not a lawyer. I'm not an investment advisor. I did do my qualifications in financial advisory about 2 decades ago, and I've been working around money ever since. I've invested in over 100 companies in Bitcoin, spoke at the first Bitcoin conference, wrote the first published book to include Bitcoin, and just been obsessing over this topic for 2 decades in both, investment banking by career and economics, and then co-founding banktothefuture.com. The experience that I give is based upon being an investor in many of these companies, because we created Bank to the Future in the first place so that I could build a diversified portfolio and allow other people to buy shares in the companies that was going to support the growth of the Bitcoin industry. I was a shareholder in Celsius, which was a crypto lending platform that recently blew up, and I'm the 21st largest creditor. With over a $10 million balance that's locked up that was about 45 million at its peak. So I'm very incentivized to try and get solutions for creditors and bring everyone with me. I also had the experience of being a shareholder in Bitfinex, where we did the first recovery plan by issuing a security token. Blockchain.com, which was the first self-custody wallet in order to achieve over 50 million downloads. Ripple Labs, building technology for the banking layer way back in the day. Bitstamp, Kraken, Robinhood, which gives you free trading by doing things in the background with your shares. That gives us this experience. Circle, which created the first stablecoin, and then Coinbase, which one of the most valuable public companies. And then FV Bank, like crypto banks and people building like Securitize on the security token ecosystem. And this is just a small portion of the companies that I've invested in. And we've worked with On Bank to the Future to bring investments to other people that gives me this deep insight into many of the industry. And we've been going deep into the crypto yield subject as a result of this. So the first thing I want to cover is the money cycle, because it gives us the insight we need in order to understand what went wrong here. So if you're familiar with my content, I've always given this concept of a money cycle. And that is that most people go wrong when planning their finances because they use the wrong money for the wrong purpose. And so typically you need money for spending. And if you don't get through this cycle, you just live in money for spending and subsidize it through debt. But once you can get past that, if you can spend less than you earn and invest the difference, then you have money for saving. And the best money for saving, from my perspective, is hard money. From my perspective, there's only two forms of hard money. There's gold and there is Bitcoin. But then you move across, once you have hard money, you have the ability to invest. And invest is to beat the returns that you get from your savings by putting it at risk. And that's when you go into more risky assets, and then you have income generating investments and growth investments. And finally, if you make enough money, then what is life worth if you can't contribute and do the things that you want to do, which is where you have your contribution money. And the goal of the money cycle is to get up this cycle. In understanding what went wrong and how we generate crypto yield, is really important to understand this cycle and what the best forms of money is for each cycle. So when you're spending, I use fiat currency because I don't want currency risk. If the majority of my expenses are in dollars, then I want dollars. And in the future, it will be a central bank digital currency, and also stable coins can be used in order to meet that. The reason for that is because if you're paying for things every month, you don't want to get on the wrong side and blow up your finances where you have to sell your savings or your investments in order to pay your rent or pay your mortgage or meet your everyday living expenses. So fiat currency always has a purpose in that when things are priced in a certain currency, you also need the spending money in the same currency. So you're only at risk of that inflation, which is why you don't save in fiat currency. Saving is what you do with hard money, and hard money has a fixed supply. Traditionally, for 5,000 years, if you want to preserve your value, not increase your value, then people have used gold, and for the 5,000 years, gold buys you the same amount of spending, of purchasing power as it did 5,000 years ago, and supply has increased an average of 2% per year. Then you have Bitcoin, which is proof of work, and proof of work is a way of verifying that there is a fixed supply and taking out the need for a custodian in the middle. So this allows you to have sovereign savings, and you can hold it in either a custodian or with yourself. And I'll go through that in a little bit to help you understand the crypto yield. But then what about investing? So investing, if you're familiar with my content, this is where I take a percentage of my savings and I put them in diversification for different outcomes. So I have like a US dollar portfolio to take advantage of the fact that central bank digital currencies could rehypothecate a Ponzi scheme. I have my Bitcoin as my savings, but then I look at things like proof of stake, Ethereum. So that's crossed into that, and it allows you to generate some yield as part of the investment. I don't consider it savings because I don't classify it as hard money because it changes form and it doesn't have commodity-like features. So it's more like an investment that now generates yield, but you can't rely upon it like you can in savings. And then you have income securities. So this is, things like in the crypto space, things like DeFi or a centralized lending that gives you some yield. And you have growth securities. So that's where you want the price to go up. Most people confuse the two. So one of the problems when you're investing is people, for example, will purchase a cryptocurrency that gives them yield, and then you're subject to growth risk plus income. But if the price of that cryptocurrency crashes, then the yield or income is denominated in that, and therefore it's like a quasi income security and growth security, but very hard to manage. So you can't really have that as your savings. It has to be an investment because it's got growth value and then income value in the same currency, crypto. And then obviously contribution. The key thing here is preventing censorship. So if you want to contribute to the things that you want to contribute to, you need the ability to own your own money, spend your own money. And if you have it in a fixed supply, it means that the things you're contributing to can also get on board the savings bandwagon as well. So this has been my lifetime work, which is pointing out that when you put your money at a bank, the bank becomes legal owner of your money. They can spend it as they choose, and they print it so it dilutes it. So now let's look at what went wrong with crypto yield by looking firstly at what went wrong with fiat yield. So here's the ownership cycle. So when people first get into crypto, they tend to come to an exchange. And I've invested in most of the exchanges because that is in my investment bucket, where shares in companies benefit from all the things that are happening in the ecosystem. And exchanges, they tend to make money when the market goes up and down. They just don't make money in sideways market, and they adjust to all the crazy things that change within our market. But once you've bought on an exchange, you should never be storing on an exchange. An exchange is just a place to come and go and trade. Unfortunately, this is the worst place to store and where most people do store, unfortunately. And so you need to graduate once you bought from an exchange to transferring it out of the exchange into what we call a self-custody application. This is where you download an app or a wallet, and you store it on your phone, for example, or your computer. And the key that controls those funds is transferred from the exchange to you, your device. So it's either on your computer or on your phone, whichever device you used. There you need a backup key, and you need to learn how to store it for yourself. If you lose that key, then you lose your coins. So you have a backup phrase, and you need to learn some of the rules that everyone will need to learn. After that is a little bit, it's not a good place to store a private key. So then you graduate to, for example, a hardware wallet, or if you have significant value and then you want to go, want to get more complex and invest more time in it, you do like a multi-signature setup, which is more complicated but essential as your wealth grows. And finally, you want to protect from you losing your private key or ransom, or you getting dementia, or you setting up an inheritable retirement plan that can be passed on for generations. And so I tend to diversify into custody as well. The key thing is not investing everything into one eventuality. This is how I've managed to get myself where anything can happen, and I can still give content, enjoy the finer things in life, because I've not put my entire life or risk in one outcome. Everybody that is suffering right now is because they put too much in one outcome. And so I hope this helps you understand that most people that have been blown up, essentially, they put their funds at what they thought was a storage or a savings account when it was actually an investment account, and therefore they were overexposed, or they left it on an exchange, and therefore they were subject to the risks of the worst place of storing it, where you were just meant to be trading. All right, so that's the foundational knowledge. Now let's jump into yield. One more. We need to look at what happened in the traditional market. So remember this diagram. What went wrong, and I call this shout out to Dirty Bubble Media that started exposing, which was the tweet that CZ tweeted that led to the beginning of the fall of FTX, or exposing the bad practices that were behind that. But he created the term flywheel, which is essentially a phrase that came from Celsius, where you use a token, you pump up the value of that token, that then goes on the company balance sheet, and then you raise funding from venture capital investors, and then you end up in a situation where you have to, you use the strength of that balance sheet, and you create an attack vector where someone like SBF or Binance or FTX can come along, attack the business model, and expose all the weaknesses behind the flywheel model. And so really what happened in the 2008 financial crisis was we used fiat currency as our spending, and because the value of fiat currency always goes down over time. So since the Federal Reserve was created, the dollar's gone down approximately 95% in value. So it buys you 95% than it used to. And it's because of Keynesian economics, where essentially, I don't want to get too geeky, they believe that spending, because you can't save, requires you to increase the velocity of money, increase the supply, and it's a debt-based Ponzi scheme. Because of that, money can't be used to save, and so it all goes straight and leapfrogs the saving into the investment bucket. Those that don't get themselves in a position where they can't leapfrog to the investment bucket, they end up subsidizing it through debt, and they use credit cards as their spending. And those that do end up in speculative assets, and you get this big rich-poor divide, which means that the rich can contribute, but those that can't, they can't get on the right side of the flywheel. By taking out savings from the equation, fewer and fewer people can get on the right side of wealth inequality, all because it's a debt-based Ponzi scheme, because you're paying off old debt with new bonds. And so governments continually print new money or issue new bonds in order to pay off those old investors, which dilutes the value of your savings, and savings exits the equation, and everyone puts it in real estate and various other things. And so what went wrong in 2008 is that everybody, in order to get on the right side of the flywheel, they leveraged their spending in order to invest, and you end up taking those assets and you borrow against them in order to try and get further and further up the investment cycle so that you can contribute more to the things you want to do. And that ends up blowing up the whole system because there's so much leverage and you have to rehypothecate. And so banks have to create money in order to subsidize the economy. You end up creating bubbles in these investments, and debt is the mechanism for doing it. That's what went wrong in 2008, where you have too much leverage, and essentially it's caused by skipping the saving cycle and taking away hard money from the fiat currency system. So now let's look at the crypto system so we can understand where yield is generated. Obviously, in 2008, Satoshi Nakamoto created the opposite of the fiat flywheel, and they gave people the ability to own their own money, spend their own money, and have money that has a fixed supply so that you could bring back hard money into the equation, which means that you bring back savings. But here's what went wrong in the crypto market. Essentially, some players created businesses that got people to take their fiat currency flywheel out of their bank and represented it as savings when it was actually an investment. So remember the difference between savings and investing. Savings is hard money, but savings investment is money at risk, and you should proportionately be investing between your savings and your investments. Also, people were going straight to the investment cycle, and it turns out that bad practices were happening with the funds that they thought they were storing in savings at an exchange. And so what went wrong here is people were putting the wrong form of money in the wrong form of storage mechanism, and then it wasn't disclosed what was actually happening. So the key to an investment is that you need to know that there is risks, and once you understand those risks, you have a suitable amount that you put to those risks in your investment, which is very different to your savings, so you don't blow everything up. Okay, so now we have that understanding. What happened with these businesses? Well, essentially, flywheel, money printing by tokens happened. So let's look a little bit deeper at that. We had these two different debates. So if you've looked at any of my content in the past, you'll know that I always talk about the difference between a trader and an investor. A trader is looking to make more dollars as a dollar thinker or your fiat currency, whereas an investor is thinking about making more hard money. So I always talked about this concept of Bitcoin thinking versus fiat thinking. So if you think about a trader came to the crypto market because really they just wanted more dollars. And so they see crypto as a way of taking those dollars, leveraging it, putting it into an investment, and trying to end up with more dollars in the end. And that's the whole concept of trading. Essentially, you're dollar thinking, and so you go into short-term thinking because you can't hold fiat for long in order to try and quickly make your buck, and it drives short-term thinking. And the problem with trading, I used to work as a market maker on the stock exchange, it drives people into the worst in humans, and really more of a gambling mindset and always chasing the faster returns. I've always summed it up that a trader overestimates what they can make in 1 year, and underestimates what they can make in 10 years, where an investor doesn't look at how much they can make in 1 year, they put together a 10-year plan. Okay, so once you have these different contexts, you understand what happened here with two of the companies that will be involved, and I'll go through the web of yield so that we can understand why this all blew up, why there was fake yield, and where the real yield actually is. So essentially, if you think about it, when SBF created FTX, a bunch of people, based upon the perception of this guru trader, thought that they were trading. So the real thing was, I thought I was trading. And in trading, you put your funds on an account at an exchange, and those funds do not and are not meant to belong to the platform. It's only when you have a banking license that you actually the bank becomes the legal owner of that money, and they can do what's known as rehypothecation. Other people call it fractional reserve banking. But essentially, you take those funds, and rehypothecation is where they become the legal owner, and they have protections and measures in place that they have in banks. So you have things like stress testing to ensure that it's not too geared or leveraged. You have deposit insurance, but if there's too many banks that go bust, you have government bailouts, and you have all sorts of oversight and regulations on such a model that is continually stress test. The problem of what happened with FTX is that based upon the reputation of Sam Bankman-Fried, everybody thought they were trading, and the money was held in custody, but it turns out that SBF was essentially trading for you. So the whole point of custody here is that when you deposit it, if you want to, for example, margin trade, which is how you generate yield. So imagine you deposit some funds to FTX and you would like to receive some income or some yield. Well, FTX would advertise that you can receive 8% or 10% on your whatever it may be, let's say Bitcoin or stablecoin. But what you would have to do is you would take the coins that you own, which are meant to be held in custody, and then you would go to an order book and it would match you up with somebody else that want to borrow those funds. Why would they want to borrow your Bitcoin? Well, they're willing to pay some interest in order to borrow those Bitcoin so they can engage in financial speculation and short it, but they only do that based upon having what's known as collateral in their account. So think through that. You hold your funds at FTX in custody. That means you own them. And then you want to put it into the investment bucket to receive some returns, which means that you generate some yield. So I'll get 8% on that. And then I'll lend it to somebody else, and that person wants to borrow it from you, so they're willing to pay you. And when they borrow it from you, they hope to buy it back cheaper, make some money on the short, and that's where the yield is generated. Now, as long as those funds are peer-to-peer, and that moves from custody to investing, then that is how the process is meant to work. What didn't work is it turns out that they had a hedge fund that was doing that trading and dipping into your money. So you thought you were trading, but essentially you weren't. You were involved in risky bets that you didn't know you were making. And that essentially creates an artificial paper balance. So at the moment, if you look at the FTX balance sheet, they say we owe all our customers a bunch of Bitcoin, but we don't have any Bitcoin. And so the Bitcoin is not in FTX, it's out in the market. And by these artificial processes, they've created synthetic Bitcoin, as it were. Now, what's the problem? Now, so that was the trading culture. So FTX was advertising everywhere, telling everyone to use their exchange and getting more and more people into trading. They were also focused on the institutional side. This is where it becomes systemic. And so a bunch of institutions were using FTX as a trading platform, which means that they have to hold their funds there in custody, and also to generate yield, which means that they are lending their funds to other people as well. So then you had the Celsius side. The Celsius is kind of the opposite. This is where you had Alex Mashinsky that was representing a culture of investing. And he was saying to everybody, take your funds out of a bank and put it into a much, much safer product, which is a low-risk savings account where we generate yield. And everybody thought they were saving, but it turns out that they were investing without knowing that they're investing. And Celsius was using those funds to make long-term bets in private equity, or they were making short-term bets. Some of those bets go wrong. Some of the funds get hacked. Essentially, rather than being in the savings bucket, you were in the investing bucket, but you had zero disclosure around what you were investing in or what the risks were. And so for the problem of Celsius was, I thought I was saving. The problem with FTX is I thought I was trading, but you took my money. I thought I was investing, but you took my money and invested. So they're two different problems from two different cultures. One is looking, duping the short-term people, and the other is duping the long-term savers, and those are the two different cultures. So let's now look through the model so we can understand where the yield comes from. Here's the token flywheel. It all really started in the 2017 ICO craze, where Binance proved that you could become a multi-billion-dollar company by launching an unregistered security called the BNB token, which was done on a buy and burn model. It was launched on top of Ethereum. And what it meant is that the more money the exchange made, the more we buy these tokens, and that decreases the supply, and therefore people invest in it based upon the management of others. Now, once they started to get a securities crackdown, they moved it more into a Binance Smart Chain and tried to decentralize it and opened up a DEX so that it was more of a layer one protocol rather than a security, but that was an adjustment there. Once Binance proved that you could become a multi-bazillion-dollar company that grew faster than anyone, everyone got jealous. And so FTX comes along and says, I'd like to do that. But they tried to do it faster and catch up with Binance. So FTX comes along and says, I'll launch my own token and I'm going to acquire all of these different exchanges and I'm going to do the regulated version. And it ends up with 138 different companies and somehow attracting billions of dollars of VC investment and using the fact to pump the token using client money. Then using that client money created essentially a flywheel for the company where you could then go to the VCs and you could get them to invest at ever higher valuations, pump more money, pay off old investors with new investors' money, and try and catch up with Binance as fast as you can. But then FTX went out and borrowed from all the different platforms as well because it wanted to grow faster. So it took its token and it went out to other companies like Celsius. Now, Celsius wanted to be as fast as possible the next Coinbase. It didn't want to do it as slow. It wanted to do it as fast as possible. So it creates another flywheel model, gets the token, pushes up the token, and then you can start increasing the valuation and grows so fast that you essentially allow people to borrow, these institutions like FTX, and you have these different models where people thought they were in a low-risk savings account, but they were in a high-risk hedge fund that was built upon, and a part of the exposure, not the whole exposure, was to companies like FTX. And then you have another company like Voyager and BlockFi and FTX then goes around to all these different companies and borrows, and they have under-collateralized loans, or they go to FTX, BlockFi, and then they post some of their flywheel token as the collateral. And as long as the markets continue to go up and everyone's buying it in the flywheel model, they can hide those holes, and they can just keep going, try and bring in new investors, and you end up with the models that happened. Then you have this interconnected industry where everybody's geared up, just like in 2008, and you have these fake balances because they thought they were custody, and you connect it to these different financial institutions. Then one hedge fund manages to come along and get $1 billion out of Voyager, and another $500 million out of BlockFi, and maybe some money out of Celsius. And then they start spending it in a wrong way. And suddenly they start making, this hedge fund starts making multiple bets. Now, because they've got a large balance sheet and a reputation, they get the best terms on the loans. So these lending platforms say to you, you're over collateralized. So if you want to borrow money, you have to put down 150%. But if 3 Hours Capital, the big hedge fund, we can just use their balance sheet as their credit rating, essentially, and they don't need to post that much collateral. And then we can use that in order to pay off other investors' yield. And everything still goes as long as the flywheel still goes. So then 3 Hours Capital gets billions and billions of dollars, this huge hedge fund, becomes the next long-term capital management, if you were, but one trade goes wrong. In fact, a couple of trades goes wrong. The first trade that went wrong is Luna. So Luna essentially was another flywheel company, which had an algorithmic stablecoin that got almost to like $40 billion or 20, I can't remember what it was, of market cap based upon backing by a token. And then they diversify some of that token and back it by Bitcoin and become a central banker and a hedge fund trying to manage all these multiple risks and discretionary fund management with all the retail people. But remember, the risk was with the sophisticated hedge funds, but retails thought they had a savings account and they thought they had a sophisticated custody trading account. Luna implodes. And then the one of the big trades that both all of the companies were using to try and generate yield was based upon the premium of the Grayscale Bitcoin Trust. And the Grayscale Bitcoin Trust is an awful product because the SEC hasn't approved an ETF. I don't want to go into that. A better product, and essentially you could essentially buy shares in the trust that was backed by Bitcoin, hold it for 6 months. And if it was there at a premium, you could then buy the spot and make at times 30%. But because of the Luna crash, they had to sell all their Bitcoin. The market went into panic. This reversed the trade, and we had these huge holes in these hedge funds. Then the hedge funds end up with having to control their margin. They're under collateralized. Everyone has these big holes. It then goes back to FTX. FTX then tries to hide these holes, and they go around frantically and try and use their FTT token flywheel to give all of these companies emergency bailouts. It gives a bunch of $240 million of FTT tokens to BlockFi as an emergency funding line of credit, like JP Morgan in 1907, and then buys the company for pennies on the dollars in order to hide all the distress and all the vast sums of money that's been obfuscated away from this. And you have this deep interconnected industry where everything is then connected. Then you have some of the most reputable companies that turned out they were using FTX, and it takes down all of these different companies that have exposure to FTX and were generating their yield in this way. And the whole thing was essentially predicated on the success of a few people's trading strategies that were over-leveraged and bailed out on token flywheels. And then the reputable companies come along and they go. So we created a house of cards, just like Lehman Brothers, where you created all these different products and they were exposed to really the flywheel of money printing that led to over leverage and people taking out mortgages and slicing the products into, and in the end, retail get hurt. So essentially, we created fake custody, which is where you thought you had your money at FTX, but it was backed by nothing in the end, or whatever's left. You were then investing in unregistered securities where you thought they were your savings account, but they were promising you yield, but they were essentially a hedge fund without the disclosure, without the suitability. And then this is where the craziness comes in. When we were doing our deep due diligence, it turns out that all of this is built upon flywheel loans. So when you are posting your collateral, they are either directly trading with those funds. And remember, the rules of trading, 90% of traders lose money at the 10% of insiders. And if you continue, they always blow up at some point, and those money gets relocated to the long-term investors from the short-term traders. But here's where it gets a little bit crazy. You were putting money in these lending platforms and posting your collateral, and you didn't know that they were trading with those funds. And those trading and those bets could have gone wrong. And they were at some stage going through the whole web of over leverage, and at some stage were connected to leverage on one of these tokens, and gets back to the FTX scenario that the whole centralized industry had exposure to. We created a house of cards. The whole house of cards needs to unwind and get back to the basics, which is why essentially you had the biggest players like a Galaxy and Gemini. Now, what they were doing is they were doing custody properly, so their custody services were less affected, but they had to close the lending services, which was unlicensed and unregistered securities, which didn't have the full level of disclosure and suitability because they were done based upon a trust company, and that trust company didn't go through the securities process. And so in the end, where is it going to sustainably come from? The last few parts of this presentation, before we move over to Twitter Spaces and take some of your questions. Well, we need to build a house of bricks. And a house of bricks consists of regulated custody in the centralized side, whereby they are fully segregated, as we've always done at Bank to the Future. Our platform, the platform company, could go bust, and the funds are segregated. If it says that you have one Bitcoin on your funds, then there'll be one Bitcoin in that segregated company. And the main platform company you're not lending them to us. You're not investing in a security. They're just on your funds. And then if you want to actually invest in it, then you need regulated securities so that you can, rather than thinking you're investing in savings, you know that you're investing in an investment, the risks are disclosed, and there's suitability so that you don't do that. And then you need what I call peer-to-peer loans, which is where this industry started. The reason I got into this industry is in 2006, there was a movement to create peer-to-peer lending. And when I wanted to create a bank way back in 2009, I wanted it where you could own your own money, spend your own money, and had the peer-to-peer lending element. That was where, when you deposit, you have custody, and custody is storage. Then you transfer it to an investment, and those investments are peer-to-peer with disclosure of risk as a security. So when you are depositing those funds, rather than them being lent to you and then them trading with your funds, your collateral, rather than them trading them as an unregistered security, I think the whole model needs to reinvent it all over again. And everyone needs to understand that custody is custody. If you receive yield, it's because it's invested in a security. And if you receive a loan, then that custody is essentially another form of securities. And so a lending license on its own is not appropriate in order to have people understand those risks. And so, as you know, we had to, unfortunately, when the whole lending companies all started imploding, we had to pull that deal, which was part of our process, and unwind and make that letter of intent, because unfortunately, everybody's exposed to this model because it was built upon the trading model rather than the peer-to-peer model. So in the future, where does the yield come from? Well, we have to completely rebuild. The centralized yield can come from essentially what we originally started, which is peer-to-peer margin lending. Those that want to borrow and those that want to lend, and there's a mechanism there for knowing that you're transferring it from custody rather than co-mingling those investments and all of the custody blowing up because you're doing stuff with it. There is also peer-to-peer loans, people that simply want to borrow money being matched up, and you have to put both people on the side of that. That's going to take a while to rebuild and actually have the yield in this platform. And then you have essentially securities-backed loans, which is that when you're borrowing and posting that collateral, you have full disclosure, and so you don't remortgage your entire house because you know that those funds are at risk, and you calculate the effect of that and only invest a proportionate amount of your savings based upon this cycle. It has to go back to what I originally said: sound risk modeling, sound collateral. We can't have it built upon these flywheels. Stablecoins, Bitcoin, and Ether are really the main risks you can manage. And also you have the decentralized stuff that did work. So self-custody staking, now that we've got Ethereum moved to proof of stake, peer-to-peer DeFi yield, that really, some of those survived the whole process because you could see it, transparency, and P2P DeFi loans as well. Those need to grow and mature. Some of them, some of them survived, but you've got different types of risks, and this becomes a game of managing those risks and not being exposed to any one outcome. So what we need to do at Bank to the Future is we're getting back to our basics. And our basics is the reason that we were not affected by this, despite everyone blowing up, is because we didn't take on any of those lending models that were essentially exposed to the whole house of cards without the correct level of disclosures and people understanding. We have fully segregated custody, and you take that custody and invest it into a security, and eventually, if we do loans, those can go back to fully securities-backed loans with full disclosure. That's going to take a little bit of a while to build. And so we're getting back to, in these different Chapter 11 processes, the basics. And what is the basics? In these Chapter 11 restructuring, you have your coins. You should own those coins in custody and have the ability to withdraw them to self-custody without creating a run on a bank. If they are staking, you should receive all those stake. It shouldn't be invested in another company. And securities. So if they made investments with your money, then you should have entitlement to those securities. So just before, I know I'm a bit over, we move over to that, I wanted to give you a bit of demonstration on some of the things that we've been building at Bank to the Future. Oh, let me do a screen share again. Let me just make sure I don't dox myself. Okay. And then we're going to head over to Twitter Spaces. Okay. So in order to put all this together, we've been building lots of technology based upon lots of these Chapter 11 processes. And now there's more and more companies in these Chapter 11 processes. Everything we've learned from the Celsius process can hopefully be can be utilized to really, really drive a reform in the way these crypto bankruptcies happen. So we've got it right now. This is not live. This is on our staging, where, for example, maybe you're part of a Celsius. You can actually import your claim based upon the information. So you can connect it. Now it uses, if you've KYC'd your account, it will know whether you have a unique name on the docket or whether you've got a duplicate name, in which case you need to provide some additional data. Now I'm the only Simon Dixon in the Celsius case. And so I can connect it, it's gone through, and it's now connected my account. Simple as one click. And now what I can see is exactly what my claim is. And we can allow it where we can allocate the pristine collateral, like Bitcoin, stables, and Ether, and that will be what we call an available. So rather than using 100% of your balance, there'll be an available. Now, we're building different features of what people can do with these different things. Firstly, you could allocate it to a company that wanted to win the bid, for example, or you could use it, some of your other allocation, to voting on something that you want to happen. Or you could use it once, for example, if, for example, you receive a security. So let's say in the Celsius example, there's GK8, a security, a company, then everybody can have it in their portfolio. So here you go, you've got, for example, GK8. And so rather than going through the process of a cash bidder buying it, we can have it where the security is distributed to all of the creditors. And then you can download your share certificate, you can see the ownership. And let's say that you wanted to actually, you didn't want that. For example, you wanted some coins instead. You could then head over to this, this market, and you could take your GK8 shares and be matched up with somebody that wants to trade some of their coins in custody for your shares in that company. And we can do that because we've been doing that for years. Now, all of these shares are, again, fully segregated, just like our retirement plans, fully segregated, so that if the platform, anything happens to the platform, firstly, we don't do the lending, we don't ask you to borrow the money and lend it to us, so our business is not leveraged and at risk, then the platform can go bust and your securities are there segregated in custody in your name and without the risk of our balance sheet. The same with your funds, the same with your retirement plans and everything we built, and you can be matched up. So we're really excited about really the solution that we've discovered as a result of being involved in these Chapter 11s is really, you just want a couple of things. You want your funds back in custody and held in proper segregated custody with proper security measures, with centralized regulated checks and controls. If that's in the US or outside of the US, different regimes. And any shares or assets that they bought with your money, you should be getting entitlement to those securities, and then you can just simply be matched up with others that maybe you lost some of your coins, they were haircut, but there's someone else that wants to take some of those shares from you, and it can all be matched up in order to maximize all of these Chapter 11 processes. Only once we've got that right, then we can start looking at what is real yield, what are the real securities based upon full transparency, full disclosures, and full suitability, and only then can we start looking at rebuilding that lending model. And so therefore, only the loans should be serviced, and they should be assets of the estate so that all creditors can benefit from all of these things that were done as a result of these crazy flywheels. So we're starting with the Celsius process. That goes through two different processes. There's the bid that starts next week, and there's a reorg, and either way, whatever happens, you can ensure that you try and get entitlement to your assets in custody and your securities. And then once we've got through the beta, fortunately, everyone else can try and benefit from this, and we can ensure that all of those funds and all of those securities, whatever's left, is for the entitlement of those that were caught on the wrong side of this, because essentially the institutions fucked the retail. Sorry for my bad language, because it was all built upon trading and misrepresentations of investments that were represented as savings, and traders that thought their funds were in custody, but instead they were being used and gambled, and we're going to get the cases out there. So I just hope that everybody understands that there is light at the end of the tunnel. There is a lot of, unfortunately, shit that's going to come from the unwinding of this process. But as always, as we always have in crypto and Bitcoin, we get back to basics, which is understanding that self-custody Bitcoin is hard money. You need your spending money, and then your investments should have full disclosures, whether they're centralized or decentralized. We need to make sure that those two industries survive to keep each other accountable, because you are alive at one of the most interesting and exciting times in financial history. Some are going to get hurt, unfortunately. Others are going to do well, and we need to make sure that you get on the right side of all these Chapter 11s and the experience that we've had at Celsius. Hopefully, if we can make all this work as an industry, we can set the standard. The regulated industry will exist within the centralized. We can start funding and rebuilding the decentralized, and we can build back a lot stronger, a lot bigger, and get ready for the next cycle, because we're going to be doing it with peace. We're going to be doing it with love. We're going to be doing it with unity. And I'm going to head over to Twitter Spaces right now to take as many questions as I can. I'll see you on the other side. Peace.